Welcome back everybody, it's Flowzone Trader here. In this video we are going to go over a beginner introduction course into the world of the stock market. So going over everything from fundamental to technical analysis. I'll give you a basic overview of technical analysis, what you need to look for, how you can make money on the long side and the short side in the market, a few step-by-step processes and indicators that you can use. And if you enjoy this lesson and you want to learn more, you can grab my course right now, which is now available to download and watch in your own time. The link is underneath in the description. So let's get on with it. So when we look at any market at all, there's two types of analysis, okay? There's fundamental analysis and technical analysis. And most of the time when you are hearing people talk, they are talking about technical analysis. They're talking about movement on the chart. But movement on the chart is driven by fundamental analysis. So what is fundamental analysis? Broadly speaking, it is a health check of the finances of that said market that you are looking at. And bigger picture, it is a look at the whole economic data in front of you of that market or any market at all. So what do I mean by that? Let's say you're looking at a very specific stock. So anything news-based around that stock would be considered fundamental analysis. So that might be how many shares are available. That might be its earnings that it has coming out. It might be a statement about its potential growth or P&L. Anything like that would be considered fundamental analysis. And that is a catalyst to move the market. So this year we've seen lots and lots of big earnings reports which have moved the market. That would be considered fundamental analysis. But bigger picture, we can also look at the whole market and the whole global economic system together. So we can look at the geopolitical news that has happened recently. That would be considered fundamental analysis. Why? Because anything that happens in politics will have an effect on the market. You will have effects on supply and demand, and that makes a difference to how the market moves. Other examples of this would be when Jerome Powell decides, or maybe doesn't decide, to make interest rate hikes or cuts. This is big picture fundamental analysis and has a huge effect on how the market moves. So the next thing to understand is, how do we use fundamental analysis? Well, my personal preference is I don't play the news, okay? I never play the news. I am not a gambling man. All I do is I wait for that fundamental analysis to hit the market and I let the market react to it and settle. And once the market is ready to pick a trend, which we'll go over later in this video, I start to join that trend and look to apply pressure to the market, continuing the direction. I don't play news. All right, I use news as a catalyst, and for me and for most out there, that is the best way to use fundamental analysis in the market. So how do we do that? We use technical analysis. So when you see traders looking at charts, what they're normally doing is assessing technical analysis. Now, I can still view fundamental analysis on the chart. All I'd have to do is go over to here, and it would show me the news on the symbols or the stocks which I'm watching. So I'm currently on Tesla, and as you can see down here on the bottom right, I can see that 20 minutes ago some news hit the market. The news that hit the market was about a recall on more than 2 million vehicles due to some safety concerns. So how does that affect the market? Well, you can see the market started to sell off from that news. So that's how fundamentals affect the market. They are news catalysts for the market to move. But when you understand the technicals, you understand the setups, and that means you can use the technicals to get in and out of positions to extract money and profit from the market. So let's have a look at how we do that. When we are analyzing technical analysis, we are looking at charts. You might have seen it on your phone, whether you're using the Apple Stocks app or Webull or eToro or whatever platform you are using, you will be viewing some sort of chart. Now, it might look like this chart in front of you. Typically, it would be red and green. It might just be a line chart, so a single line moving on that screen. But all charts are analyzing the same thing. What they're really looking at is price versus time. Okay, so on this vertical axis here, you will always have price, and on the horizontal axis, you will always have time. So that's how you can think about a chart. A chart is analyzing price versus time. Now you can choose the time frame in which you're analyzing price in, and that will all come down to what type of trader you want to be and what type of analysis you are doing. So currently I am viewing price over 10 minutes. So each single candle here, which is these bars, each one of those represents 10 minutes in time. But I can change the time by looking at higher time frames. So now this is looking at a daily chart. So each bar represents 1 day of price action, okay? And the horizontal axis now, you can see, goes right back to August and July. So all the way from July to the present day of December. So I'm viewing now the last 6 months almost of price action, okay? So it makes a difference into how you are observing price, because trend will look different based on the time frame you're looking at. So now we've gone over what a chart is. A chart represents time versus price. A candle, which is one of these bars, all right, one of these is considered a candle. That represents price within a time period. So currently this is 1 day. So within this 1 day, we have price action. So I can zoom down to a 10-minute, for example, and I can see that within this day, this is what the price action has done. Okay, so this is a 24-hour period. Well, we're still open, so slightly less than. This is 1 day's price right now inside this block here. So we can zoom this right down. Okay, inside this block is 1 day's price action, and we can have a look at price within the block the day before. So that would be from the 12th right here all the way up and all the way down here. This block here would be yesterday's price action. So this would also be one single candle on a daily chart. But as you can see, it was a much bigger move in terms of price action. We moved up, then down, then closed near the high. So I'm going to get into that briefly in a moment. But what I must say is this huge move here, up, down, this was driven by fundamental analysis. Okay, we had a big news event yesterday. We had core inflation data, and that caused this move here. So understanding the importance of fundamental analysis and how it affects technical analysis, it all plays in together, and that is part of being a good trader or a good investor. Let's go over candles very quickly, because they represent price within a specific time like we talked about. So let's just go over this candle right here. This was yesterday's price action. This is a daily chart. So this candle represents 1 day, and you can see that because I have 1 day up here. So the candle can be split into two main parts. The body, right? The body of the candle would be this part here. And then the wicks. The wicks are these lines at the top of the candle and the bottom of the candle. Now, not all candles have wicks, and they are not all the same size, and that is for good reason. So let's get into that, because what it comes down to is what's known as an opening, a high, a low, and a close. So in a candle, you have an opening on a green candle, which is a candle that moves upwards. The opening would be the bottom. This right here is known as your opening price. All right, that is the price at which the candle or that day's price action opened. And the wick at the bottom, that's where price action came to. So at one point during that day, it came all the way down to that low. So that's known as the low. Now we also have a wick at the top, which means price action also came all the way up to the top. So that is known, you can probably guess it, as the high, all right, as the high. And after price action hit that high, it came down and it settled here, and we closed here. We closed the session here, and we will open up in a new session the next day. So this right here is known as the close, all right? That is the close. So those are the four main parts of any candle, and you can do that over any time frame, a weekly, a monthly, even a 1 minute. It all works the same way. So this is how a bullish candle works. We open towards the low part of the body on the bullish candle, and we close up. That's different to a bearish candle. A bearish candle is a candle which closes down, okay? These would traditionally be red, but they are white on my screen. It's just how I like to use it. So on a bearish candle, this top would be known as the open. Okay, that's where price opens. The tiny wick above it, you can see we have a very small wick above it. Price didn't really move much higher that day, but that would still be known as the high. And price that day came all the way down to this low, so that is still known as the low. And the last thing we have is the close. Okay, the close is the bottom of the body right here. Okay, this would be the close. So that's the difference between candles which move upwards and close up or go down. All right, that's why a candle is red or is green normally. Now, like I said, my candles are white and green, not red and green. It's just how I like to have them viewed. So as you can see, a high and a low, they're always the same. The high and the low are the extreme points of the wicks. The difference is, if it's a bullish candle, it opens towards the low and it closes the session towards the high. And a bearish candle opens towards the high and closes towards the low. So why do they differ? They differ because of the candle that predates it. I want to show you what I mean. This bullish candle here, if we just view this price action here, we close near the high and then we open right next to it. Okay, we open next to it. It's always the way price action works. We open next to the previous candle and we push up and we close near the high. These candles here do the same. We push up and then we reopen, and we push up and we reopen. We open near the close of the previous candle, but this time we close downwards. All right, and that's the difference between understanding the opening, the high, and the low and the close. The 4 points of the candle with 2 parts: the body of a candle and the wicks of a candle. I just want to go over a 5-minute chart and talk you through it so you start to understand that it doesn't matter what time frame you're looking at, charts work the same way. So let's start with this big candle here. So we have an open here. During this candle, we hit this huge low, but buyers came in and bought this up, and we moved all the way up. We have a small wick high, and we close here. So we go to the next candle. We open where the previous candle closed. We come down a little bit. There's a small low here. Buyers bought it up. We came all the way up here to a high before they sold off and came back down and closed with this big wick on top. And then we open in the next bar. Okay, the next bar, again, exactly next to the previous bar's close. And we open and do a huge push up, and you'll see the same thing. We open a new bar. We do a push down, coming to retest this area. I'll go over that later, before soaking all the way back up, and we close near the high. Again, closing near the high. Then we open up this time and close near the low of the last body. Okay, we're into bearish movement now. Then we open here on the candle. Okay, the top of the body for a bearish candle. We drive all the way up. There's lots of selling pressure, so it pushes us all the way back down, and we close lower. But this time we open next to the previous close. As always, this close here into this open, and we start driving up again. Okay, so you can see how the opens and closes are always next to each other. Okay, so where a candle closes, the next candle will always open next to it, or there or thereabouts. Sometimes there is a small disparity in it, but it's normally about there. So how do we make money from the market? It doesn't matter what market you're looking at, whether that be cryptocurrency, whether you're looking at options, whether you're trading stocks, or whether, like me, you trade futures. We make money the same way, and that's by taking advantage of price movement within a set period of time. So when I'm looking at this chart now, I know that currently we are in a very big trend to the upside. So if you are able to buy the market at this low and sell the market towards this high, you would have made a substantial amount of money. And the same can be said to the downside, all right? You don't just have to take movement to the upside. You can be a short seller. So if you are shorting the market here, which means selling the market here, and covering or buying back your shares at this bottom, you would have made an awful lot of money. So it's understanding price action and how it moves. And the way we do that is by understanding trends, support and resistance, and supply and demand. So moving on to trends, all right? Trends are something that I like to look at in the market, and the way we do that is by drawing a trend line. Very simple, very similar to what I just did. A trend line will join up by multiple points. You can use wicks or you can use candle bodies, and the movement of that said stock or market will respect the trend. So you can see here, we make this wick at the top, we reject, we come down, we tap it and we reject. We tap it again, and now we've got 3 taps, which for me means this trend is a strong trend. And we reject it, and we don't even make it towards that high, and we continue to move lower until we eventually break that trend. And once we break that trend, you can see that this candle here is very large. And that's because everyone who was short selling or selling this market on the way down, they sold here, they added more sell here, they sold more here, they sold more here. Once we break this trend, that's confirmation that this trend to the downside, a downtrend, is now over, and we are now into a potential uptrend. All right, and that's why this candle here is big, because everyone who was short is now getting out their position, and the market can get some relief and move to the upside. Now, the other way we can look at trend is by understanding market structure. I'm not going to go over this in detail in this video. If you want to learn more about advanced market structure, you can grab my course down below. There are a lot of modules on this in exact detail on how I use it. But essentially, a downtrend is defined by lower highs and lower lows. So if this is our point of origin, this low here is lower than this. This is a lower high because this high is lower than this high. This is another lower high because this high is lower than this high. And then we get a break of structure. Again, I go over this in the course. We break this structure, we break this low, and we make a new low. So now we've got a lower low. This low is now lower than this low. This high lower than this high and this high. So we have a series of lower lows, lower highs, lower lows, lower highs. And that is what a downtrend would look like. An uptrend would look exactly the opposite. Okay, if I skirt over to here, we can see an uptrend. Just zoom out a moment. So here you go, the start of an uptrend. You would do the same thing we talked about in terms of a trend line. You can see a very steep trend line here. This was from the COVID point, okay? Once we broke out, and we have 3 touches, 1, 2, 3. So that confirms the trend is strong. So once we break that trend, you notice we come up and reject that trend. We try it before moving back down. But during this trend, we had a series of higher highs and higher lows. If I just point this out, higher high, higher low, 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 until we top out, and then we get a change of character. Again, this is where we get the downtrend start. I go over this in the course. If you want to learn about market structure and how you analyze technical parts of the market to extract money from it and make a profitable routine to trade or invest, you can grab that course in the description down below. So that's how we analyze market. Markets are always doing one of 3 things. They are either in an uptrend, they are in a downtrend, or they are in some form of consolidation. And in consolidation, we are either accumulating or distributing. So when we are going sideways like this here, okay, we're boxed in, the market here was distributing. What does that mean? It was flipping from buying up to starting to sell positions, and then we get that move down. And we get the same the other way around, right? When we're boxed into positions like this here, this was an accumulation. So instead of selling this time, we are making higher highs and higher lows. It's accumulating shares, it's accumulating size for the next leg up. That's because we can't just move straight up and straight down. We have to accumulate position size and also trap participants in the market and use their stops as fuel. Again, that's something far too advanced for this video, but something I get into in my course. So I want you to look at this chart. This is an hourly chart, and we're just going to go from this point down here, okay? And you will be able to see that we are very clearly in an uptrend. It doesn't matter where you do that trend from, okay? There's lots of different ways of drawing trend. as areas of support, which is what I'm going to go over now. But you can see we are in an uptrend, and potentially we have trend line resistance, something like this. Okay, so I could do this as red. Potentially, it doesn't have to be that way. So the same way that we analyze price on the upside, we can look for potential points or pivots where price action might get stuck. So you can see every time we've come towards this red line, we've pulled back away from it, right? That would be very typical trend line resistance, known as support and resistance, or in this specific case, Malaysian support and resistance, known as Malaysian SNR. Another thing that I teach in advanced ways in my course. So looking at this, I can now analyze price with support and resistance. So very quickly, what does that look like? When we talked about the way that price moves up, okay, that would be your typical uptrend, wouldn't it? So when we hit this line here, this was resistance, all right? It was resistance because we failed from it. Once we broke through that resistance and came back, it became support. That's the typical rule. Resistance becomes support, RBS. And the other way around would be support becomes resistance. So in a downtrend, something that looks like this, okay, this old area of support where we found a bounce from, we would draw that in right here, and that became resistance, all right? So that's another way of viewing the market. SBR, support became resistance. And this one, just to remind you, RBS, resistance became support. And we can do the same when we look at potential moves above and below trend lines, which would be something like this. If I put a trend line in here, this would be the resistance trend, and we broke through it, and now it is acting as support. Okay, that's now acting as support for a move higher. That would be very typical resistance and support trading. That would be how I analyze the market using trend line, resistance and support. So again, here we could do this. I'll do it as blue because this was definitely an uptrend. Okay, and then we found a tapering channel where we moved sideways. We talked about consolidation. The market needs to move sideways for a bit. So we now have a new support structure here, and a potential resistance structure would be somewhere like this. All right, I will refine this very slightly. So now I'm thinking about this, what could I expect price to do? Because we're getting tight, aren't we? It might want to come and revisit this, okay? It might want to do this, and at some point it might want to break out and now use that resistance as support. That's a potential move. It could also do the opposite, all right? It could go the other way. It could get tight in here and then break down and use this and start to build a downtrend. These are all things that are possible. So once you understand support and resistance, both in trend lines and the horizontal way that I taught you, you can start to understand how price moves. So now I'm going to just zoom in here so you can see yet again the horizontal one. So here we have very clear level of resistance, right? Here, 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 it's all the same level. So I'm going to do that as a block, and I'm going to do it right here. And we'll do that as red for resistance. Now you'll notice that once we broke through this level, right, we tapped it once, twice, 3 times, 4 times, 5 times before doing that U shape, that curl, and we tapped it and we got above it. Once we got above it, we did what's known as a break and retest. All right, this is how I like to trade the market. So that resistance, which actually is a form of supply because there's sellers up there, so they're adding shares to the market, selling to the market. They broke out, it became demand. We tapped back in and then we moved away from it. All right, so this is how I use supply and demand. Similar to support and resistance, very, very similar, but it's more general areas. Now I go over ways that I define demand and how I draw these areas out in my course. So again, if you want to study that course, the link is down below. And if I'm feeling generous, I might even put a sale on and give you the code. Here you can see the same thing. We created demand. It was created from this old supply, right? This area here would have been red for me because we kept rejecting it. So we make that red. So you can see old supply, break and retest. Now it's demand. So we held it, we push up. Second time in, third time up, create supply, come back in. demand, fourth time, supply again, demand, fifth time, sixth time, supply then, seventh time, supply again before we break and retest. And now we might do the same thing as we've done here above it, all right? So we're stair-stepping to the upside. That's how you analyze price action. Within this model here, so now I've shown you support and resistance, and I've shown you supply and demand on a very quick basic view. Within this, we have patterns, and the patterns are really important because that's how you will start to recognize what the market's trying to do. So when I look at patterns, very simply, I'm looking for two things. I'm looking for types of U-shapes or curls, or I'm looking for types of triangles. Now, these can be split into lots of different things, okay, and they can be joined together. So common patterns that I look for all the time would be things like head and shoulders, which would look like this. Okay, so that would be a head and shoulder. So as you can see, that would be a bearish pattern. So this would be your left shoulder, your head, your right shoulder, and the neckline. And traditionally, the break of the neckline would be your move downwards, right? That would be a bearish pattern. This is all about liquidity and stops. This is how all these patterns work. It's all about understanding liquidity and stops. And the inverse would be something like this. So this would be your right shoulder, and then we'd extend away. Okay, so this would be left shoulder, head, right shoulder, neckline. Okay, so that's one very common pattern I look for. Another common pattern I would look for would be a cup and handle. So that would be a U shape, basically with a triangle, and it would be like this. And I'd be looking to participate as a buyer in this handle if I'm not already in at the bottom of the cup. And the same would be the other way around. The pattern would look something like this. Okay, that would be the inverse pattern for a bearish move. So let's have a look now within these charts, shall we, and see how many times these patterns start to show up, because I can see them pretty much all the time. So instantly in here, okay, you could say that is a U shape. All right, a big U shape. Within this, we have a left shoulder, head, right shoulder, okay, neckline, and you can see the break away, okay. And again, this would have been supply, and we broke through supply. What else do we have? Here is another one. This is actually a double bottom in here in a U shape. So there's a U shape, but in there we create demand. This is a W shape, something I also like to look at and teach in the course. Let's continue to move up here. So this would be a squeeze for me. This is a nice triangle right here, something I would participate in as a flag. It's known as a flag. We break out to the upside. Here again is a very nice head and shoulder. There's your left shoulder liquidity, head, right shoulder liquidity, neckline break. So as you can see, they happen all the time. And within that whole thing, if you were able to zoom out, you would understand that this right here was a cup and handle. Okay, so these patterns play out all the time. And once you start to understand supply and demand, support and resistance, what the trend is and what patterns you are looking at, you can start to really dial into the market and start to participate in the direction of the trend. That's the easiest trade to take rather than a counter trend. I do trade counter trend trades when I have good thesis behind it, but I would encourage newer traders to focus on joining trends. So what are other tools we can use to help us join trends? Well, if I go down to a lower time frame, let's go to a 3-minute. What are some other tools we can use to help us get in and out of trades? I like to use EMAs, exponential moving averages, right? They show the moving average of a set period of time. Now, I use 3 main waves, which I call the flow zone waves: 13 and 21 EMA, a 35-50 EMA, and a 72-89 EMA. That's all based on rolling Fibonacci numbers. So I have this right in here, okay? These are my flow zone indicators. Now, I'll have to zoom in so you can see them a bit clearer. But you can see that when my EMAs, my flow zones, are blue, I am looking to join trends. You see how lovely that is. It holds trend. And when it is red, okay, I'm looking to sell. So as you can see here, we came up to supply that we identified. We failed to move higher. We created an inverse head and shoulder. Okay, you'll see it right here. and we sold down using my EMAs, and then we got underneath an IB level. This is a very, very important setup which I teach in my course, and we continued to sell off into demand. Once we got into demand, we started to go sideways, right? We had an area of consolidation where they started to accumulate a position to go long. We break out of that consolidation, we are now in an uptrend. Higher highs and higher lows, and the flow zone indicator, the EMAs, are supporting that, right? It's supporting price to continue to move higher, and you'll just see it will do it over and over again. We move into supply, we fail, we come back, we hold, the EMAs go blue, we go back up. All right, it's very, very simple. So the way I like to use them are not as complete signals. I'm not using any form as indicator as a signal. So the best way I can put it is, if you are looking to ride a bicycle for the first time, if you were teaching your child, let's say, you would have them use stabilizers. These EMAs, these are stabilizers, all right? They are letting you know what price is trying to do, and then you can use all the other methods, all the very simple things like analyzing where flags are, like looking for curls and U-shapes, like looking for head and shoulder patterns, analyzing trend to help you know and execute the market in the direction. But these stabilizers, they're going to help you keep the right side of the trade. That's why I made them. That's how I designed them. Now, there are some more advanced techniques to using them, which would be far too much to go over in this very simple beginners video. Now, if you are enjoying this beginner course and you want to learn more about the markets, more about price action, and gain my key setups, then all you have to do is hit that link below and you can grab my brand new course, Flow Zone Trader from Beginner to Advanced.